Alice in Dataland podcast is a trip through the looking glass into autonomous learning investment strategies. Adil Abdulali is the President and Chief Science Officer of Move 37. All opinions expressed by Adil and podcast guests are solely their own opinions and do not reflect the opinion of any firm. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions. Clients of Move 37 may maintain positions in strategies and securities discussed in this podcast.
Hello everybody, welcome to another episode of Alice in Dataland. I'm Adil Abdulali, President and Chief Science Officer of Move 37. I'm joined here today by Raphael Douady, the Frey Chair Professor of Quantitative Finance at Stony Brook University. Raphael, why don't we start out by giving us a little bit of your background?
Thank you, Adil. Real pleasure to be here today. I've been a pure mathematician for many years before starting to doing finance. It's a bit by chance that I got the opportunity to first work for Société Générale in Paris when they were needing a mathematician, and they told me, it doesn't matter if you don't know markets, we'll teach you markets, we need your math. So that's how it all started, put a little finger in it, put the whole body. That was 94, so that's 24 years ago. And since then I have put the whole body. I've worked a lot with different financial institutions, at the same time teaching mathematical finance, organizing mathematical finance seminar at Paris and then at the Quant Institute. That's NYU. I created this company, risk management company, Risk Data, with Igmar Adlerberg, which we sold about 4 years ago. And since then, I'm teaching here at Stony Brook with fantastic students, I must say.
Great. Well, today I want to explore a little bit some of your interesting work in risk management as it applies to quantitative finance and the markets in general, because as you know, Move 37 is deeply involved in the intersection of man, machine, quantitative finance, and the markets. So, there's this concept of fragility that has been introduced by yourself and Nassim Taleb, and I think it has a lot to do with the interaction of human beings in the markets. And I don't think the lay people know much about fragility and anti-fragility. Perhaps you can give us some of your thoughts on that.
Yes, the idea, I must confess, initially comes from Nassim Taleb. He's famous for the Black Swan and all those extreme events. Extreme events is also something I've been focusing on myself, independently of Nassim, with different mathematical tools that I've developed. So we've been working a lot together. The fragility idea is to differentiate between systems in a complex environment which benefit from changes in the environment. So the environment may be, very stable, on the contrary, very volatile. And some systems are more robust than others to changes. And some systems even benefit from variations of the environment. You may have, for instance, a boat on the sea without wind, it will just not move. So some systems need to have some shaking of the environment in order to be able to evolve.
So isn't this concept of fragility then linked to what we understand in markets as convexity?
So precisely this article that we wrote together, Nassim and myself, on the mathematical definition of fragility is very much related to what people know on option trading, what we call the Vegas, that's the sensitivity to volatility, and the gamma, which is a convexity of the option. So basically the convexity, convex means something that is round that way. Concave means something that's round this way. And so a convex system is a system when the underlying moves, the system benefits from it. And it's mathematically related to the fact that the more volatile, the more you benefit. And on the contrary, when you have a concave system, then when it starts moving, you start suffering from it. And the more it's volatile and the more you suffer. So that's the basis of the anti-fragility theory.
So that's in the market, something that survives and benefits from change, or can withstand a lot of change without getting affected in a negative fashion. Are there examples in life for the layman away from the markets that are...
Life is a good situation because precisely through evolution, through Darwinism, essentially everything that's fragile tend not to survive. So those who survive are the anti-fragile or at least the robust systems. Let me give you an example. We all need to be protected against all sorts of disease, bacteria, viruses, etc. And so we have an immune system. The way an immune system works is precisely to learn from the aggression from the environment and to build up systems inside our body to protect our body against that. If there were nothing to learn from, then we would be completely exposed. And so the immune system is the archetype of the anti-fragile system. Of course, if we have, too big of an aggression, we may die from a disease. But if the typical functioning of any animal, any human being, is the fact that a certain level of variations of aggression from the environment is beneficial to us. So that's a good example of anti-fragile system that we have developed through ages, through millions of years of evolution.
That's interesting. So anti-fragility is very closely related to adaptability in a sense, or the ability to adapt to different environments.
Of course.
And that's
a deep idea.
It's an interesting segue to what we're trying to do with the autonomous learning investment strategies, or what is traditional equation-based, hypothesis-based trading and machine learning or adaptive trading. In a way, see if you agree with this, is that the traditional quant was fragile. You wrote certain equations and if they start working, it would create disasters. And the idea is to have something that's more adaptive. Would that be anti-fragile in your mind?
There is certainly something anti-fragile in the machine learning, in the new artificial intelligence systems. Nothing comes without a danger. I mean, evolution, species disappear by themselves. I tend to say that the biggest enemy of a very good idea is the idea itself. If there is an enemy to capitalism, it's less socialism than capitalism itself. So we will see that systematically. So eventually we have to watch out. AI is definitely a beautiful idea. It may become its own enemy. If we need always to have a second pair of eyes to watch on the system. However, let me give you an example of, there is always fragility now when you take a system that works at a small level and you try to scale it up, expand it, and up to a point where it interacts with the whole system. A good example was the famous crash of 1987, with the idea of options. People thought that they could have a dynamic strategy that would protect them from the downside by simply being more and more invested when the market's going up, less and less invested when the market's going down. Very natural, seems no problem, up to the point where on the downturn of the market, people starting selling off, and everybody starting selling off together, was not just one marginal investor. It was the whole bulk of the investment community who started selling off, and they blew up the market. So you see that by trying to create convexity at the marginal level, they created an enormous concavity at the systemic level. I tend to say that convexity is a zero-sum game. If you try to create convexity, you pay it by some concavity somewhere. So it's a matter of scale. You will see you're very trained with analyzing all the hedge funds, and you've seen that practically any active strategy has limitations in capacity. And the base reason for limitations in capacity, people tend to say, yeah, if I become too big, I cannot get the same level of return. Probably true. But the real limitation is that if I become too big, then my risk, my unknown risk, my systemic impact becomes too big, and I cannot afford it. So, yes, there is, of course, something very good in an anti-fragile in all the subtleties that artificial intelligence is able to capture in the whole complexity of financial markets compared to simple strategies like, for instance, portfolio insurance, which is one we spoke of. But at some point, we ought to monitor the size, the volume of it, to make sure that it's not destroying itself.
Right. So let's switch a little bit to your past again, and to wrap this up and find out a little bit more about yourself. What were some of the inspiring characters in your past? That when you were growing up, who was your inspiration intellectually or otherwise?
No. They very interesting. I mean, first of all, what makes me slightly different from the usual person in mathematical finance, especially from France, who...
You're from France? Who would have guessed?
Apologies for my accent. The vast majority of French people in mathematical finance come from the probability theory, and there is a very strong probabilistic school in France. One of the major characters was Paul Lévy, but there's a lot of great people in probability. The latest one who I admire and died recently is Marquior. There's a big Russian school. There's a big American school as well in probabilities, and so that led to a lot of mathematical problems in math finance. However, my background was in dynamical systems, so that's chaos theory, problems of stability, and problems of dynamics, and that I see when I have this natural tendency when I look at financial markets. Instead of, if there is one major difference, let's put it this way, major difference between the probabilistic view and the dynamic view, is that all the randomness of markets in the probabilistic setting is exogenous. You have, like you throw a dice, like in a Brownian motion, you always throw a dice and say, okay, well, whatever number on the dice will make you go right, left, etc., up or down. Whereas in dynamics, it's a consequence of what's happening. So you have something that falls up. And I always have this idea coming from dynamical systems that markets are dynamics. So that gives you a certain understanding of crisis, of all those dynamic effects, those instabilities, all these anti-fragility when you were speaking of, where you have a domino effect, one falling the other, etc. And that's a typical dynamical concern. So that's the first thing I look at. So that has an impact on the way I'm doing mathematical finance, the way I understand markets, because my eye naturally is focused on the dynamics. My father, you're asking, as who are big people, certainly my father himself was one of the greatest French mathematicians, Adil Douady. He was the person behind the whole theory of all this Mandelbrot set dynamics of those complex polynomials, all those fractal pictures that we see all over the place. So Mandelbrot did a lot of simulations, but the real mathematical theory,
the power law stuff,
was developed. Well, there was some theory that was developed in the 30s with Julia and Fatou, but then there was a revival of the theory in the 80s and later, and that was essentially, my father was a leader of all that school. So I was surrounded with, and today you have thousands of mathematicians working on that. So yeah, I knew Mandelbrot when I was a kid already, because he was visiting us, and I was always surrounded by all those people. So
great mathematicians, basically.
Yeah, mathematicians, geometers, dynamicists, etc. So would I say one particular person was standing out of it? I mean, of course, the relation with my own father is so big that it dwarfs all the rest.
Yeah. So when you're not doing mathematics, what do you enjoy doing? Or finance?
I like enjoying life. I like classical music.
You play an instrument?
I used to play the flute. Haven't touched it for a while. Just lack of time. I like beautiful environment. I have a particular love for the south of France.
Well, the next podcast, maybe you can play a little tune for us and something, but it was very nice to have you here today, and very nice to have you on our advisory board to, tell us everything about the mathematics of finance and guide us. So thank you very much.
Thank you, Adil.
Thank you for listening to Alice in Dataland. For show notes and more information on Alice and Move 37, please visit our website at www.mov37.com.